$7 billion. That is the amount of peer-to-peer transaction volume Polygon processed in November alone. It is triple the volume we saw in January. We are seeing adoption from Stripe, Indian telecom giants, and massive stablecoin inflows. The fundamental usage is undeniably hitting all-time highs. But then you look at the price, and it tells a completely different story. We are sitting at 12 cents. The chart looks absolutely disgusting. We are testing liquidity wicks that I didn't think we would ever revisit. The market is effectively saying this project is dead, while the on-chain data says it is more alive than ever. So, who is lying, the price or the data? Today, I'm taking a short-term trade right here at the bottom of the barrel. I will show you exactly where my stop loss is, because if this level breaks, it is lights out. Let's be real for a second. Holding Polygon over the last year has been painful. I have been accumulating this token since it was 3 cents back in 2021. I took profits on the way up, but this current price action, it is frustrating. We are trading around 12 cents. The sentiment is in the gutter. Most people have given up. They are looking at the migration from Matic to POL and scratching their heads. It feels like the rebrand did nothing but confuse the retail market. Many investors feel like the team dumped on them, or that the tokenomics upgrade was just a distraction. However, capitulation is usually where the opportunity hides. While the price has been bleeding out, the network has quietly become a utility giant. We need to look at what is actually happening under the hood before we get to the charts, because the disconnect between value and price has never been this wide. Look at the data. Polygon is not competing on hype. It is competing on utility. Payment applications on the network hit $1 billion in volume in November. That is nearly 3 times what we saw at the start of the year. Stripe alone routed $64 million in USDC on Polygon this year. That puts it neck and neck with Ethereum for Stripe usage. We are also seeing local currency stablecoins, like the Singapore dollar and the Brazilian real tokens, crossing 10 billion in lifetime volume. This is not whales shuffling money around to farm airdrops. Half of these transactions are between $10 and $100. That is real retail activity. That is people buying coffee, paying bills, and using the network for what crypto was promised to be. There is this narrative that Base and Optimism, the superchain, are eating Polygon's lunch. And yes, the superchain has 60% market share if you combine 30 different chains together. But if you look at Polygon alone, it is sitting at number 2, holding double-digit market share against a combined supercluster. On top of that, we have news of Reliance Jio, the Indian telecom giant, deploying on Polygon, and a new Korean won-backed stablecoin launching. The usage is going parabolic. When you have this much volume and stablecoin liquidity, it usually creates deep yield opportunities in DeFi. Speaking of yields, when you see this kind of volume, you need to know how to extract value from it beyond just holding the token. If you are trying to figure out how to properly farm stablecoin yields, manage liquidity pools, or understand the security risks of these protocols, I have compiled my entire system in my DeFi guide. It covers everything from Aave strategies to portfolio allocation. It is available in the pinned comment and costs only $4.99. It is the playbook I use daily. Now, let's see if this fundamental growth can actually save the price.
We are looking at the 3-day time frame here. This gives us the best signal-to-noise ratio. The first thing you will notice is this massive descending channel, marked by these orange dashed lines. We have been trapped in this structure since the local top of 77 cents back in December of 2024. Right now, we are sitting exactly on the biggest support level on the chart. We are testing the wick from October 10th. That was the day we saw the biggest liquidation event in crypto history. I honestly didn't believe we would revisit this zone, but here we are, trading between 11 and 12 cents. The trend is undeniably bearish. We are below the 10 and 21 EMAs. Those are the blue lines. We are below the 55 and the 100 EMA. There is no bullish trend confirmation yet. However, we are looking for a mean reversion play. Look at the Heikin-Ashi RSI at the bottom of the screen. We are in extreme oversold territory. In fact, this is a record low since the migration to POL in September 2024. I have marked previous oversold instances with white circles. Every time we hit these depths, we saw a relief rally. We are currently deeper than we have ever been, suggesting the rubber band is stretched to its limit. If we do get a bounce, where are we going? The volume profile shows our point of control. The level with the most trading volume is up at 24 cents. That acts like a magnet. If we anchor our Fibonacci retracement from the December high down to our current lows, our first major resistance is the 236 level at 27 cents. Before that, we have local resistance between 17 and 20 cents. Here is my strategy. I'm treating this as a separate trade from my long-term bag. I'm adding to my position here in this load zone between 11 and 14 cents. But, and this is critical, I have a hard line in the sand. My stop loss is set at 10 cents. If a weekly candle closes below 10 cents, this setup is invalidated. If we lose 10 cents, the next technical support on the channel bottom is all the way down at 6 cents. I'm not interested in riding it down there. If this support holds, I'm laddering my take profits. My first target is 20 cents. If we hit that, I move my stop loss to my entry price to make it a risk-free trade. My second target is 27 cents. If we clear that, I'm looking at 36 cents and eventually 52 cents. This is a classic risk-to-reward play.
This is a battle between macroeconomics and product market fit. On one hand, the usage metrics are screaming undervalued. Stablecoins, payments, and corporate adoption are exactly what we wanted to see in a Layer 1 or Layer 2. On the other hand, the price action is capitulation. My thesis is simple. The market is currently mispricing the utility of Polygon because of the migration fatigue and the obsession with newer shiny objects like Base. However, I'm not marrying this bag. The stop loss at 10 cents is my insurance policy. If the market wants to flush this to zero, I'll be out with a small loss. But if the mean reversion kicks in, the upside to 24 or 27 cents represents a solid double-digit percentage gain. Bottom line, I don't understand how a token with this much development and usage is priced this low, but the market can remain irrational longer than we can remain solvent. That is why we use stops. I'm betting on a bounce here, but I'm keeping my risk managed tightly. If you found value in this breakdown, make sure to like and subscribe. I post daily updates in my free Telegram group, so if you want to know the second I sell or add more, join the community using the link in the pinned comment. I also covered Ethereum recently, which has a very similar correlation to Polygon right now. Check that video out right here. Thanks for watching, never financial advice, and I'll see you tomorrow in the next one.